Let's talk about portfolio risk and return and look at some basic ideas of diversification and how portfolio risk can decrease the more assets you have in your portfolio. And I'll look at this by looking at a situation where there are two assets, but also a situation and what happens when you have more assets within your portfolio. So in terms of diversification and portfolio risk, the basic idea behind having a portfolio is there are two sources of risk: market risk, which is effectively the risk that is attributable to broader market movements, i.e. it might represent the sensitivity and responsiveness of your underlying security to the returns on the market index. It refers to factors that are market-wide that can affect the stock price movements. It's also called systematic or non-diversifiable risk, which implies that it cannot be diversified away. The other type of risk is firm-specific risk. Firm-specific risk pertains to all the myriad things that can happen on a firm-specific nature that might drive returns in a random direction. So, for example, it could be a factory burns down, or it could be the CEO resigns, or it could be any number of other random things. You can have positive ones, you can have negative ones. These are random and they are unexpected. These can be eliminated by diversification, because on any given day, one firm might have a really positive surprise and another firm might have a really negative surprise. The two will ultimately, over the long term, cancel one another out. This is also called idiosyncratic, diversifiable, or non-systematic risk. I'll typically use firm-specific and idiosyncratic rather interchangeably. Of course, firm-specific only really applies and is only really a relevant term when you just have a firm and you're talking about the firm's risk. If we're talking about a portfolio, oftentimes one will use idiosyncratic risk as the term instead. Nevertheless, they're often used interchangeably. We can think about this in terms of a basic graph. So with a basic graph here, if you have on a horizontal axis the number of stocks and the vertical axis the standard deviation for the portfolio will trend downwards the more stocks you have in your portfolio, i.e. you'll start to eliminate or near eliminate this idiosyncratic risk, and you're going to be left over with market or systematic risk as what your risk exposure will ultimately be. However, that obviously will take several assets being in your portfolio. Now we can see that as a general rule of thumb, the more stocks you add, of course, the lower your portfolio risk is ultimately going to be. Generally, when you get around 30 or so stocks in your portfolio, you'll have reached most of the ends of the diversification benefit. Now, what you can see here is the benefits of diversification mean your standard deviation will go down, but it will go down at a decreasing rate the more stocks you add to your portfolio, telling you that the incremental diversification benefit of an additional stock starts to decrease over time as you add more stocks to your portfolio. So in order to explore this more, let's start off with a situation where you have two assets, which will give us a concept of what risk ultimately looks like. And then we can go through and look at this when we have more assets within our portfolio. Let's start off by defining our portfolio return. So suppose we have two asset classes. We have a subset of equity and a subset of debt. So your equity part could be an ETF that follows equity. Your debt could be maybe a fixed income ETF or whatever it is that you're looking at. So the portfolio returns are simply the weighted average of the returns to each of the individual assets, weighted in proportion to how much they contribute to your overall portfolio's value here. So your portfolio return, simply the weighted average of those returns. Similarly, the expected return is the weighted average of the expected returns on your individual assets, i.e. returns are just the weighted average of the returns on the constituent components of your portfolio. That's basically what the returns are going to be. What about portfolio risk then? Well, in our two asset case, we're basically just using the variance formula in order to calculate portfolio risk. The variance formula basically stipulates that the variance for our portfolio is going to have really two categories of variables. Firstly, the variance category, and then secondly, the covariance category. So it's going to be the weighting squared in each of the constituent assets multiplied by their relevant variances, plus 2 multiplied by the two different weights multiplied by the covariance between the two assets. That's simply what the variance formula is when you have two assets within your portfolio, i.e. it's just the kind of a weighting assigned to each of these individual variances. Notably here, the covariance portion is important. This tells you that the lower the correlation between the assets, the bigger the diversification benefit you will get. Because as this tends towards zero, this is going to tend towards zero as a term. So hence why it's important to have not perfectly correlated assets. Now, this means that when we have this variance formula, we're going to have quite a number of different terms going into it. So for example, say you have n assets within your portfolio, you're going to have n variances that you need to add up, and n squared minus n covariances. So there's quite a lot of terms you might need to estimate if you have a large portfolio. We can then think about the concept of correlation. Now, the covariance measures to what extent the two returns will move together, and that's an important concept. The correlation then scales this covariance so that it is going to go from -1 up to 1. So the correlation by definition is the covariance between the assets divided through by the two individual standard deviations, i.e. it is basically just scaling the covariance. It is going to range from -1 up until +1. A correlation of 1 tells you that things are perfectly correlated. A correlation of -1 tells you they're perfectly negative correlated. A correlation of 0 tells you that the returns on the assets will not move together at all. So that's effectively what the correlation tells you. It's an important concept in terms of being able to tell you to what extent, if at all, asset returns move together at all. We can then think about the concept of the global minimum variance portfolio and the optimal risky portfolio. Now, the global minimum variance portfolio is simply, as the name suggests, the portfolio that has the lowest level of risk or the lowest portfolio variance. It is expressed as follows. In a two-asset case, you can mathematically solve for what the weight should be to any individual asset. It comes from effectively minimizing your variance. It would come from taking the derivative of the variance of the portfolio with respect to the weights. Noting, of course, that in a two-asset case, the weights obviously have to sum up to 1. You could obviously also do this through something like Excel Solver. Now, this obviously is a relatively neat formula in order to solve for that weighting. However, one could obviously do it through differentiation if one wants to do so. Similarly, when you have an optimal risky portfolio, the optimal risky portfolio is going to be the one that maximizes your return per unit of risk. It is obviously going to be rather more complicated than the global minimum variance portfolio. The optimal risky portfolio, of course, aims to also consider expected returns in addition to just considering risk. These obviously can be done and solved using Excel Solver, which is how one would often get the efficient frontier if one wants to do so. So to give you an idea of diversification benefits, we can effectively see this in a graph. So in our graph, we can combine together assets. So suppose we have two assets, D and E here. Say, for example, they have a correlation of 1. If they have a correlation of 1, there is, in essence, no diversification benefit from combining the two together. You would just select one based on how much risk you ultimately wanted to take on. However, as we start to reduce our correlation, we start to see we get more and more of a frontier of potentially optimal portfolios that will give you a higher level of return per unit of risk. When the correlation is -1, you can potentially get a riskless hedge. We can go long in one combination and short in the other combination, thereby effectively enabling you to get an arbitrage opportunity. You can also get other diversification benefits. The lower the correlation between the assets, the lower the overall portfolio risk, and the better efficient frontier you would ultimately get, because you would be able to achieve a high level of return per unit of risk. The amount of possible risk reduction is going to depend on that correlation. A correlation of 1 is going to tell you no risk reduction is possible. A correlation of 0 means that you can get quite a high amount of risk reduction, and potentially your portfolio risk is going to be less than the risk of either underlying asset. A correlation of -1 tells you a riskless hedge could potentially be possible. Now let's have a look at the situation where there are multiple assets and discuss what happens in terms of diversification in that context. Now, to understand portfolio risk, we're going to need to start off by understanding individual securities. And individual security stock returns are often going to be derived from a model like the single index model. The single index model stipulates that the returns for an individual asset are going to be a function of its alpha, which basically represents its over or underperformance, its exposure to the market return, and an idiosyncratic component, i.e. an idiosyncratic error or risk. Now, to explain what is happening here, the alpha is effectively any outperformance the firm might have or underperformance relative to what you would expect based on market movements. This portion, the beta multiplied by the return on the market, that represents the sensitivity and responsiveness of the firm's returns to the returns on the market index. This error term represents effectively the idiosyncratic component of the firm's stock return movements. Now, firm-specific components are given by the alpha and the error term. Now, the alpha term, like I said, is kind of this average, overperformance or underperformance. The error term is this firm-specific random component. On average, the error terms should equal to 0. Therefore, the firm's expected return is just going to be given by the alpha plus the beta multiplied by the expected return on the market. This is because the expected idiosyncratic term is 0, because you might have positive movements cancelling out negative movements over the long horizon. The CAPM is a subset of the single index model. The CAPM stands for the capital asset pricing model, and it slightly stipulates a different model. It basically states that the expected return on the market is the risk-free rate plus its beta multiplied by a market risk premium. It's a slightly different model that does not explicitly include a firm-specific component. Now, we can arrange the CAPM model to look slightly different, and we can rearrange it to look slightly like the single index model, with kind of what looks like something of an intercept term and something that looks like our slope term. However, it is obviously not the exact same as the single index model here. So the two are quite different in nature and quite different in underlying philosophy. So the question is then, what is beta? Well, beta is clearly a measure of the sensitivity and responsiveness of the firm's returns to the returns on the market index. It is going to be effectively derived from the covariances and variances thereof. So in the single index model, the beta is effectively telling us to what extent, if at all, are the firm's returns moving with those of the market index. A higher beta tells us a greater sensitivity, a lower beta tells us a lesser sensitivity. The beta can effectively be any number, but in practice is going to generally be somewhere between 0 and 2 in general terms. Now, importantly, the betas here are going to tell us to what extent the asset returns are going to depend on market returns. The beta can be 0, it can be 1, it can be more or less than either of these. In terms of types of companies with this, we can think about Twitter. It has a beta of about 0.88. Many banks are going to have betas of approximately 1. It is often derived through a regression approach. The regression approach is effectively going to regress the firm's returns onto the market index returns. From the regression, we get the alpha as the intercept and the beta as the slope. And from the regression, we'd also get error terms. The variance thereof is the idiosyncratic volatility of the underlying stock. Now, in terms of risk measures in this context, we can think about it broadly speaking. The firm's total risk is going to have two components, a market component and an idiosyncratic component. So, in terms of the market component, this is effectively going to be this beta squared multiplied by the variance of the market returns. In terms of the idiosyncratic component, it's just going to be the variance of those error terms, the idiosyncratic volatility. There's going to be a systematic component and a firm-specific component. This, of course, assumes that the covariance between the returns on the market and this error term are equal to 0. So that's effectively what our firm-specific variance and volatility is going to look like. A systematic component and a firm-specific component. This ultimately becomes important when we're constructing a portfolio. Now, the covariance of two individual securities are then just going to derive from their market components. This is because the error terms are firm-specific, so the error term for two individual stocks is not going to be correlated at all. So the covariance between these two returns is simply going to be the product of their betas multiplied by the variance of the market returns. This greatly simplifies how we calculate variance in this context, and it can make it quite a bit easier to calculate our expected variances for our portfolio in the long term. And that's effectively what the market risk is going to come from. We can also see that this will have impacts for firm-specific risk in a portfolio of multiple assets. So when we have a portfolio of multiple assets, we can see the correlation between two individual securities. That's going to come primarily from their betas here. You can see the correlation, simply by definition, is the two betas multiplied by the market variance over the standard deviation of each. we can expand this out by adding a sigma squared for the market on both the numerator and the denominator. If we do that, these would cancel one another out. So the correlation between the two assets is simply the product of the correlations between those two and the market, which again means that all correlations can be related back to the market, which makes life significantly easier when constructing a portfolio. We can now think about what this implies for diversification. So to think about this, we need to think about what happens to the portfolio's overall idiosyncratic risk exposure as you add more and more stocks. We need to recall that these individual idiosyncratic risks are not correlated with one another. So let's have a look at the idiosyncratic risk component of the portfolio. It's simply going to be the sum of all of the average rather, of all of the idiosyncratic risks for each of the individual assets. Now what this implies is that as you add more and more assets, 1 over n is going to approach 0. So as you add more and more assets, your actual exposure to each individual asset is going to get lower and lower. And therefore your exposure to idiosyncratic risk becomes negligible the more assets you have. This means your risk exposure ultimately becomes your exposure to market returns, i.e. you're only exposed to market risk. And in particular, as you're adding more and more securities, your returns are going to approach those of the market index, and your composition will approach that of the market index. And therefore your beta for your portfolio will also start to approach 1. And if your beta approaches 1, your overall risk is just going to converge to market risk. This then draws us back to portfolio diversification. And as per our prior graph, the more stocks you're adding to your portfolio, the less exposure you'll have to this diversifiable or idiosyncratic risk. And your risk exposure is going to be primarily derived from systematic or market-wide risk exposure. And this tells you the diversification benefits that a portfolio can ultimately achieve. So I hope this has given you a bit of an idea about how to go about analyzing portfolio risk and return, where the risks and returns come from, and how it is that when you have a portfolio, your exposure to idiosyncratic risk will start to decrease the more stocks you have in that portfolio. Now, I hope this has given you a bit of an insight into how portfolio risk and return operates, how it affects diversification, and how the concepts are broadly related to one another. I hope it also gives you a bit of an insight into what is the global minimum variance portfolio, and also what are optimal risky portfolios. In any case, I hope very much this video has been useful to you and given you some more insight into portfolio construction. And I'd like to thank you very much for listening in, and I very much hope to see you for future videos.